if 61% of people are living paycheck to paycheck, I don't think that means that they're poor. It just means that they just spend everything.
Mm-hmm.
And so they don't know how to say no or have delayed gratification. So therefore, I think it feeds on itself.
Definitely.
So if all your friends have new cars, but they're paying $1,800 a month, you don't see that. They don't talk about their payment, right? Welcome to a Wiser Retirement Podcast, where we believe the best financial advice should always be conflict-free. I'm your host, Casey Smith, guiding you to financial freedom today, or my co-hosts, Missie Beach and Michaela Dowdy. Hello.
Hello.
Hey, Casey.
Welcome back to another week of a Wiser Retirement Podcast.
Thanks.
So I saw an article. I'm going to start here today. I saw an article by RIA Intel that there was a study done by the CFP board that indicates that all Americans believe that all financial advisors are working in their best interest. And I was like,
sorry.
What the heck? And you know what? Honestly, I expect that because our industry is so hard to understand that you think that a guy at Merrill or Morgan Stanley or
Wells Fargo.
Wells Fargo,
Edward Jones.
all these guys and gals, you think that, oh yeah, they're good people. So they just work at these big companies and they're, my advisor's a nice person. Of course you like the person or else you wouldn't have done business with the person, but it's their toolbox. It's not so much them as the problem.
Right.
It's the toolbox is the problem and who they're working for.
Yeah, the structure.
And who
where
are they
work.
serving?
Mm-hmm.
Are they serving themselves? Are they serving the company? Are they serving you? And the reality is they're serving two people, themselves and the company.
Yes.
Exactly. That's the reality. And to the point where 96% of firms are out there selling something, where 4%, like us, are fee only. Only 4% in the entire industry are fee only firms. So it's very interesting that when polled, that 97% of Americans agree that advisors who provide recommendations about retirement investments should be required to act in the best interest of the client. So everyone agrees that this should be the case. No one says, I just want to go to a salesperson and buy this product. Nobody says that. 97% said that they agree advisors should work in their best interests. The same people say that 92% of the same people believe that it's the case in their current relationship.
Yeah.
And this is the problem that I have with the CFP board. And I understand it's a business in the end. You have all the fancy advertisements you see on TV. You have to have revenue to support that. Mm-hmm. But if you're a certified financial planner, you've basically signed an oath that you're going to work in the best interest of the client. You signed a fiduciary oath, right? Well, then you go to work for the bank or, wherever. Mm-hmm. If the company's not accepting fiduciary duty, that promise has no standing whatsoever, right?
That's the gap.
So really you can be a CFP and that's great. And you can introduce people. This is my certified financial planner. And there's all these assumptions that therefore that person has gone through basic training, understands finances. In the meantime, you could have a person who doesn't have a CFP at an independent firm like ours, who is a real fiduciary, not a pretend fiduciary.
Yeah. The word is meaningless. I mean, at the bottom.
The fiduciary word's
line,
meaningless or the designation?
No. Well, I would say the word. Let's still give a little credit to CFP board you standards. You have to do some a lot of education.
Yes, it's a legit process to get the designation.
But the word, I would say is meaningless.
To the
general
consumers.
Public. Yeah. Right. But it's amazing how many people come in for their consultation. Number one question, are you a fiduciary?
Yeah, they do ask that.
And, I think I should be more direct in that and say, well, yes, but, anyone can really say that.
Mm-hmm.
Yeah.
But the bottom line is that we are fee only, and we're going to sell you nothing.
Mm-hmm.
Right.
So
That's very true. The fee only portion does kind of trump everything else, I guess.
it's great to be a 4%er.
Yeah.
Fee only 4%er.
That's very true. So yeah, I don't, another thing too is like, in most of these relationships, they're getting paid by the product. So for example, let's say that you're still working, you're mid-career, you change jobs. Is it the best idea to move the old 401k into an IRA?
Maybe yes, maybe no.
But we look at the maybe yes, maybe no. But a person who's at a brokerage firm, the only way they're making money is if you're moving that rollover over.
Oh, yeah. Oh, how about, for example, a government employee with the thrift savings plan,
TSP.
the TSP?
Yeah.
So low cost, but yet you'll find an occasional client who they're like, oh, well, my old guy said, roll that into my IRA.
Right.
And you're like, oh my God, that was so low cost. Why would you have done that?
Especially those firms that prey on the military and the government, like First Command?
Yes.
I think it's an Edward Jones version of people who just tailor to people in the military who don't know the difference.
Yeah.
Yeah. So anyway, I just saw that and it's like, wow. I mean, but I get it because it's so complicated, and we've done so many podcasts and articles about this, especially 10, 15 years ago, in our blogging. But the reality is, you have your traditional business model where you're buying product. So you're paying 4.25% commission to buy a mutual fund. And then the advisor gets a trailing fee. Mm-hmm. And every time you make a trade, there's another 4.25% potentially. And that's how then you wonder 5 years later why you didn't make any money, and the market was up. And that's because you're losing 4.25% every time they make a trade for you. But typically in those situations, they don't have discretion. So that means that they have to get your permission to move something. They're not just doing it, churning it by themselves. Now that does happen. And then you have the other business model where they're charging you a flat fee. The rat fee is kind of high, but they're still getting trailing fees on the back end of that. So your total cost is over 2% per year, and you don't even really understand that.
Well, that's the thing. You can't really see it on a statement. And that's where people think, oh, well, I don't pay my advisor anything. And I'm
Correct.
like, but you do.
Right.
So we'll try to pull up the ticker symbol of the mutual fund to show a client like, oh, you did pay a lot for this fund. They're like, oh, I didn't realize I paid 4.25% when I bought it.
Yeah.
I'm like,
yeah. And
sorry.
They're still paying 0.9% holding
trailing,
it, which is crazy. And then there's this fee-based model, which people get confused with fee only. But the whole fee-based model is these people leave these big brokerage houses. They create independent firms that looks a lot like ours, but they're still selling the insurance.
Mm-hmm.
So you still have
annuities,
or the annuity. So you have the fiduciary standard, but then you stop at some point in the relationship and you put on your sales hat and you're selling a product and you're collecting a commission. Now there is a rapid increase in products that don't pay commission. So fee only advisors can participate. But honestly, all the ones I've seen are kind of junky.
Yeah, they are.
It's just somebody else keeping the money. It's the same cost, for the most part. We have a annuity rescue program through Nationwide. So if a client came in with an annuity and they're paying ridiculous fees, we can get that transferred into a product that's charging $25 a month as opposed to 3.5%, right? So we can get these we can get annuities saved, but we would never recommend it if you had cash, we would never be running to that product. But those are called fee-based models where they're fiduciaries during the planning process, but then they sell you something on the other end. And then there's the fee-only model, which were fiduciaries through asset management and the financial planning process, both. And if we need life insurance, so we have great people we trust in the Dave Ramsey network to help us, and they're great people. So really, there's no need for that. But I don't know how you get on top of this, because part of the problem is the marketing from the big firms make it look like they're just like the 4%, and they're not. They're the 96%.
Yeah.
And so unfortunately I come back to, well, I feel like there needs to be more regulation. I mean, some of these people, like, their whole tagline is, we make sense of investing. Like, how can you make sense of investing when your disclosure pages are 30 pages long? That's not making sense of investing. That's just confusing the customer. But again, they're the $1 trillion market that people flock to because they think that it's safe, and they're leaving so much money on the table. But anyway, the government could fix this. It's called a fiduciary standard for all. But what they're doing is they're watering down what fiduciary means. To your point, Missy, is that every time there's a fiduciary standard that comes out, there's lobbyists that fight it, that are mostly insurance companies, because they can't sell their crappy products anymore.
Yeah, when they've got the big lobbying bucks, so they're going to be the loudest voice in the room. You
got to remember that if we decided to sell products, some of the commissions on these things are like 10% commission. We can make millions of dollars overnight in fees if we decided to use these products.
Yeah, but then, like I tell our clients,
we would violate our fiduciary standard.
And we couldn't sleep at night.
And we couldn't sleep at night. Yeah.
That's what I tell all of our clients. Michaela and I get to sleep well at night because we don't sell stuff that clients don't need.
Okay. It doesn't happen very often, but if a client gets upset about something, I mean, we had a situation a few weeks ago, and after I kind of hung up the phone, I thought, man, you know what? I knew exactly where I was coming from. I know exactly where I was standing, and it was in this person's court. I was in their court advocating for them this whole time. The problem is there's probably some other emotional things going on with this person. I didn't think it was entirely a rational conversation, but the bottom line is, like, what do people do? What do advisors do? They're selling stuff.
Yeah.
Like, how do you defend yourself when you know for a fact that there is a cheaper product, when you know for a fact there was a better process? Like, how do you do that? I don't.
I feel like it's almost like they have the perspective of, like, I'm owed this fee because I'm giving this fee or this product to you, and I'm the one that's brought it forth to your attention. So then I should be making money off of that, which is just so conflicting to the overall fiduciary duty.
Yeah. I don't know. I just knew that I'd done everything for this person above and beyond what the standard is. And in the end, they realized that, and the conversation did very, very nicely. But I just can't imagine how people defend themselves who don't do that. But this is Financial Literacy Month, and you think, oh, big deal. And then you go read some stats about financial literacy.
It's scary.
We have 10. We have 10 stats we found in our research on this. All kind of sad, really. Number one, 56% of adults are financially anxious.
This seems so low to me.
You think it's higher?
Yeah, I think it has to be so much higher. I think a lot of people did not answer correctly. Or maybe 2022 wasn't too awful of a year. The market was up that year, right?
Well, it's interesting you say that, Michaela, because you're the youngest person here. And they did note in the study that the younger Americans are feeling the greatest burden.
There you go.
So that would take her peer group.
Oh, yes. Okay.
The youngers are feeling the most anxious.
Yeah.
So the percentage is higher for younger people. And actually those between ages 18 and 34, 69% say that they're financially stressed.
That makes a lot more sense in my head. I was thinking like 75%. I feel like I don't know of any.
Yeah. Yeah, because the whole I'll never buy a home and kind of thing.
Yeah. No, it's we have more conversations with our clients now about, we graduated college, we put $5,000 down on a starter home, and we bought our house. Yeah. And that same starter home is going to be $50,000 to $100,000 down now. So yeah, I could see that. And then you're having to live in apartments with people around you more, which creates some anxiety too, I would think, depending on where you live.
Yeah.
Definitely.
Number two, 22% of U.S. adults lack an emergency fund.
That's frightening.
That's a bankrate.com study.
Yeah, living paycheck to paycheck.
Yeah, and that was the next one. Number three, lending report. 61% of adults live on paycheck to paycheck. That's a lot of people. Think about it.
Wow.
I feel like that's so much of an issue because we have like credit cards so readily available now. I feel like having that has made it to where not having an emergency fund, you don't feel it as much because it's like, oh, you know, I need a new unit or something. It's like, well, we'll just put it on the credit card and then I'll pay it off later.
Well,
that is their emergency fund.
Yes,
I guess.
exactly.
If 61% of people are living paycheck to paycheck, I don't think that means that they're poor. It just means that they just spend everything.
Mm-hmm.
And so they don't know how to say no or have delayed gratification. So therefore, I think it feeds on itself.
Definitely.
So if all your friends have new cars, but they're paying $1,800 a month, you don't see that. They don't talk about their payment, right? You just see new car, new furniture, new house.
Mm-hmm. There has been a trend lately on TikTok where it talks about these people that got their cars like really young. They're like, oh, you know, got a $1,800 car payment because I had to have leather seats and a backup camera and all these things. And they're like, regret it so much. And you're just like,
and now they're stuck with it.
They're like, but my car's pretty.
My car's pretty.
Well, you know, we even have clients, a couple could earn $500,000 and still live paycheck to paycheck.
Oh,
because,
absolutely. Yeah.
You know, keeping up with the Joneses, and they just don't have that discipline to save.
Yeah. I actually get energized in those meetings because I get very animated and I'm like, aren't you tired of living like this?
Yeah. Because you don't have to. It's a choice.
Wouldn't you like to roll over every morning knowing that you're financially secure and you don't have to go slay dragons today in order to make your minimum payments? Yeah, there's usually always ways out of those situations. You just have to buckle down.
Are you curious why annuities keep coming up as a potential investment option? People are often told that annuities can effectively mitigate investment risks and help secure their financial future. However, annuities often benefit the salesperson and might not be the best choice for you as a consumer. To learn more about the various types of annuities, the negatives of owning them, and better investment alternatives, we have a free ebook on our website just for you. To download our ebook, Buyer Beware, Why Do They Keep Trying to Sell You That Annuity? Simply click the link in the episode notes or visit wiserinvestor.com/guides. Now let's get back to the episode.
Number 4, almost 3/4 of Americans budget on a monthly basis. That seems high.
Okay.
75% of Americans say they have a budget and follow it to keep track of spending.
They're lying. I don't think 75%.
But only 16% revealed. 16% revealed they actually spend more than what's their monthly budget.
I feel like a monthly basis is a lot to be even reviewing it.
Yeah, I don't even have a monthly budget.
I don't either.
I mean, I kind of know when things are starting to go awry, but I don't budget on through a spreadsheet.
Well, I think it's
I did when I was
that,
younger because you had to.
Mm-hmm. And it's also just like the pay yourself first kind of method that we talk about, where it's like if you're saving first and that's coming out of like an automatic withdrawal to those accounts, then you kind of are just really spending the money that you have in your account. And you know that like that's okay because I've already built up my emergency fund. I've already built up my 401k and like those kinds of investments. So it is interesting to have a monthly review for 75% of Americans.
This is a problem for young people. Over half of the youth in the country aged 15 to 18 failed a financial literacy quiz. Did you look up that quiz?
Okay, yeah. So for fun, I looked up like a basic financial literacy quiz, and it's scary if that many people are failing a basic quiz because questions are like, what's the difference between a debit and a credit card? Or what's the main purpose of a budget? Here's one. You earn $2,000 a month and your monthly expenses are $1,500. What's your monthly surplus? So, I mean, we're not asking rocket science here.
Right.
I mean, these are like basic
I thought they would be
math.
like, what's APR versus APY? Or
No, we're not even going that deep. You know, like how much should you have in an emergency fund?
Wow.
You know,
and we're failing
1 month
over
or
half.
a year. Yeah.
So some states have high school literacy classes, financial literacy classes. Georgia just started one, I think is this year, maybe next year, but it's soon. It hasn't started yet.
I did one in high school. That
You
was
did?
a requirement. Mm-hmm.
I love
Personal
that.
finance.
Go Tennessee.
35 states scored a C, D, or F for high school financial literacy.
Wow. I'm sure Georgia's one of them.
Yeah. So 25 states, which would and DC require a high school personal finance course to be offered. 21 states require high school course to be taken, and then 9 states are required standardized testing related to financial literacy. But only 9.
That's okay. At least, I mean, it's getting there.
Well, but you think about it, colleges, I don't know necessarily do it better, but of all the people not going to college now, I mean, that's a high percentage of people that just going to have to go figure it out or hope their parents taught them something.
True. You know, well, I think back to my school growing up, like we used to go to home ec to learn how to cook and sew.
Right.
And we went to shop class to learn how to use tools
That's
real.
Crazy.
And now, so things like this are
So
taking
you can change
the
oil
place.
in a car, or that's not shop
No,
class?
that'd be like
Auto
auto
class?
mechanic.
Oh.
I didn't.
You didn't
go
do
there.
that?
No.
Shop class is like you are drilling 2 pieces of wood together.
Yeah.
Oh yeah.
Like I made
I
a
missed that.
napkin holder.
I didn't get that class.
Yeah. I was in the Midwest. We had stuff. Well, and I'm older than you. But now, okay, so schools are replacing those antiquated things with things like financial literacy. So I think the trend is shifting away from the 50s and the 60s and
Right.
the 70s.
Right. So now we just can't fix anything, but we can do
Right.
it.
We just hire people to do all those things and send food to us. But yeah.
This one makes me sad. 90, this is number 7. 90% of millennials are in debt. So student loan debt has reached $1.75 trillion. $1.75 trillion. Wow. That's crazy. That's just the student loan debt. Then you have to add the credit card debt on top of that. But the average, let's see, the top 25% of them have student loan debt that averages $56,000. We met someone recently that had, I think it was close to $400,000 in student loan debt, which is crazy.
A doctor.
Yeah, to anesthesiologist, if I can spit that out this early in the morning. But yeah, she'll make that back. But it takes some discipline to get through that. Number 8, 60% of adults had credit card debt in the past year. So it kind of piggybacks on number 7, in that, there's just so $1 trillion in credit card debt right now, according to the Federal Reserve Bank. And it's young people that have most of it. So that's crazy. Sometimes that's hard to come back from. So you have to be careful with that. Number 9, 50% of adults experience barrier to home ownership. We've been talking about this for a while. I mean, you have rising home prices, you have all the student loan debt and credit card debt, which reduces your ability to qualify for the loan. Mm-hmm. They don't have savings. And then the cities are getting more expensive, right? Mm-hmm. And of course, you have poor credit and history or score. And I think that's fine. If you have poor credit history and score, you shouldn't be buying houses. That created the financial crisis to begin with, was the start of it. But the rest of it is just a situation. I mean, we could have a whole debate on college right now, but I think a debt-free college education is, for most of us, is going to be the way to go. We don't want to exit college with debt.
Oh gosh, no.
Yes. I think that's huge, because just knowing from peers of mine that have student loan debt for whatever reason, it is definitely like demoralizing for them. And like just being able to, you're having to pay that off, and they're trying to pay it down aggressively as you would want to. And then it's also just, like you see your other friends that don't have the debt that are getting to do more fun things. And it's just like very like heartbreaking for them. And it can feel like, oh my gosh, like you're trapped. And it's like, no, well, we're still in our 20s. It's okay.
Yeah.
But it is something that's so hard to get out of, because then it's like you're having to make those payments, and then say something happens and you need new tires on your car. And then that's like detrimental at that point.
Oh yeah.
Because you're not having this influx of savings that's extra. And especially like at the time that a lot of us got out of college, then inflation started rising aggressively. And so it's been to the point where it's like maybe what you're making on the starting salary, if your job hasn't been great to increase your cost or your salary, then you haven't kept up with the cost of living. And now what you thought you could save, you can't. And your rent's going up by $1,000 or whatever it can be. And so it just becomes so quick of a slippery slope, sadly, which makes sense to all of this being able to go into debt as the younger people are, but definitely a different shift, I guess.
And sorry.
I'll insert my opinion here. At a recent board meeting at a college I'm on the board of, I brought up this topic, and it wasn't exact right form, to getting legs, but just threw this idea out there that if students are taking student loans, there should be a process, and the government will have to create this because you have to make it equal for everybody. But there should be a process that you go, okay, I'm a history major. I'm not going to go get a master's or anything else. I'm just going to be a history major. And history majors across my region of where I live have an average income of X. So if that's $50,000 a year for life, then you probably shouldn't be going to Duke and be a history major, because you're going to come out with hundreds of thousands of dollars in credit card debt. Maybe you should go to your local school and be a history major, right?
Exactly.
Now, if you go to the business school and you say marketing versus accounting or finance, then, there's a wide range of things that happen, but you can still come up with an average for each. And so the bottom line is, before you sign this piece of paper saying, I'm going to borrow 25, 100, 500,000, whatever it is you're borrowing, that you understand your ability to repay, barring you being lazy, disability, whatever. Right. And so there should just be an awareness. But when you're 18, 19, 20 years old, you have no idea what you're signing. Yeah. You just know you want to go to school, and you've been told you need to go to school, and no one's really talked to you about the consequences of that loan. Yeah. And that would solve it.
It would. I think the other thing too that I know has been floated around as ideas at different universities is like actually assigning the tuition based on what the average income is.
Yes, that was my second point.
For the future of
business
like their
schools
average
should cost
people.
more than the art school.
Exactly.
I like that idea.
Because especially for what your average person is coming out of that school. Like, I mean, I know.
I have the same comment for, where does the school put all its resources?
Yes.
Because the liberal arts schools are really good about kind of spreading it all equal. We're all equal. And I'm like, well, I don't see anyone on your board that was an art major, an agriculture major, or an education major. Everyone was a business major. Yes. So it seems to me you should be pumping more dollars into the business side, so that you have a higher ROI as in the institution is better off, 50 years from now.
Who's giving the money?
Who's giving the money? Exactly. So it's kind of like, if you're going to put your cards down and you're going to bet on the horse, you're not going to bet on the horse. It's been in the, it's been in the backyard for 20 years. You're going to bet on the horse that's been trained and has a chance. Now, there's obviously a lot of business people that never make over $100,000 a year, but
true.
Statistically that doesn't seem right, across all business schools. So but anyway, I digress on this. I think financial literacy should include students understanding the loans that they're going to be responsible for, and even parents. The parents should understand at that point. They just may have to say no, but we've seen this in the past. If you're going to go into the ministry and be a pastor, you don't need to go pay a full ride at Duke when you can go to UGA, because if you got into Duke, that's 1% acceptance rate. I think you could probably get into UGA, right? So go there, go on the Zell, and have almost a free education versus paying private, because you're going to go into an industry that's not known for making people wealthy, right? That's not here on earth anyway. So anyway, I just want to open this with those stats. I think we tend to, all of us live in the world that's within the 4 blocks of our house and don't really always see the big picture. But that, teaching people about money is very important. If you're a parent listening to this podcast, teaching your kids about money and how this stuff works is really important.
Yeah, I think if you have teenagers, especially, have them do a basic financial literacy quiz. I mean, just Google it.
I mean, I've talked before on this podcast. It's been a little while, but my daughter's an equestrian horse rider, and when she needed some expensive saddle, I was like, "This is ridiculous," but I made her take the Dave Ramsey course. I really didn't understand that it was so long. It took her like 6 months. It was
just take the course.
It was 2 full semesters of that. And she still complains about it to this day. But if you see her talk to other adults who knew that she took it, she says things that you're just like, oh, that's good that you know that. But yeah, so let's talk about, what is financial literacy? What are the basics that should be covered when you talk about financial literacy? If you were designing a course, Michaela, how would you design a course?
I feel like first you really have to talk about your cash inflows and outflows and understanding. I know we're talking about, we don't really necessarily have budgets in our households, but like having at least a ground floor of like, this is what should be anticipated as expenses, whether that be your fixed expenses or your fun expenses, discretionary spending, those kinds of things, just to go ahead and have that basic knowledge. And then further, going into, okay, what is debt? And like going into those different topics and really getting into, I saw a video the other day of this girl who's probably like 16, and she had no idea, fully understanding what the credit card was. Oh. It was like her parents giving her a credit card, and they were like talking about it, and they were like, okay, wait, so explain to us again what you just said. And she was like, well, there's $600. I have $600 to spend. And they're like, yes, and you're going to have to pay that back because you've now put $600 on this credit card. And she's like, well, why? They gave me $600. It's like a gift card. I got $600. Like a gift card. Great. And I was like, oh my gosh. Like, so definitely like going through just even the basics of the basics. I mean, I know even someone who majored in finance, literally Missie and I laughed about this the other day, that with my own credit card, I was under the impression on that due date, it had to be fully, like there had to be a 0 or I was going to get charged a fee, which is not true. It's like the balance of your statement from earlier, like, which is such a giggle, but it's like, honestly, that's where having that information of just like even the basic knowledge of how to pay these things, exactly what the nuances are. But definitely starting first with the budget.
I saw this video, this guy recording his wife. I'm sure that it was all staged so we would talk about it. But she was going shopping and she was returning something.
Shopping math.
Yeah, the shopping math that she's returning. Math? Yeah, is returning something. She's returning something for $50 and she bought something for $100. But she said, well, it's half off because I returned something for $50. Yeah. She's like, that's math. But you paid $50 for it already, so you spend $150. No, I only spent $50.
But I think in real life there are women that think that way
because it's already spent and paid for, and therefore, that's hilarious.
Like a fixed cost.
But probably guys too, just at a different store.
True. But other things financial literacy encompasses are like a good understanding of credit score and how that works. Yes. Like one thing I was teaching my oldest son when he got his first credit card that was not one of ours, it was in his name just to establish his credit more. I said, okay, this is not like our card. So if you make a bigger purchase, realize your credit line is only $1,000. Right. You never want to use more than 30% of your available credit line. Right. So if you make a purchase, you want to pay that off during the cycle. Don't wait for the due date because you don't want to get that utilization ratio up. He's like, oh, well, how would you know that? Right. I'm like, because I just told you. Right. Exactly. That's how you now know that.
Yes, exactly.
But a lot of our clients don't realize that.
No. Yeah,
because they think, oh, I'm just going to put it all on this one card instead of all these other cards. I'm like, actually, don't do that.
30% of your max credit limit is what you should be topping out.
Yeah.
Yeah. I'm just working to the point where I don't need credit. So who cares? But as a business owner, that would be a little careless. So, so you do have to watch that. I think I would just add understanding how to build wealth to that.
Mm-hmm.
You have to understand that you have to live below your means, and excess money has to go. It starts off in brokerage accounts or 401ks or wherever, but eventually you have enough going there, and then other money can go other places. And that's how you end up with second homes. And that's how these people, our clients, end up with hunting properties and all this other stuff because they live below their means otherwise. And they're just putting a lot of cash away. They're not spending every single dollar unnecessarily.
Yeah. And that's only after, like you just said. Let's concentrate on the word after you've secured your retirement.
Yeah. Yeah. And emergency reserves and all that.
Yes.
So again, I think officially 4 pillars, debt, budgeting, saving, and investing. Those are all things that should be understood in a financial literacy course. I have this quote from Warren Buffett: the best investment you can make is an investment in yourself. The more you learn, the more you'll earn, which is
I like
very
that.
true. What are the benefits of financial literacy? Honestly, we had this whole thing with like Black Lives Matters a few years ago. We had all these riots and people were upset about social things. And I sat and watched all that and I was like, okay, they're upset about these things, but nobody, no platform talked about the most suppressing thing. And that's just debt.
Yeah.
Mm-hmm.
No one talked about that, this is the USA. You can go earn money almost anywhere. You got to have the ability to go do it.
Mm-hmm.
But the opportunities are out there. You just have to go knocking on doors. There's stories of people who had to knock on 50 bank doors before they ever got the first loan to start their company. And so it's possible. You just have to have that grit and that persistence. But for people who have lots and lots of payments, what they lose is opportunity. So you can't change the job. You can't change your domestic situation. You can't change anything because you got to go make those payments. Well, you're going to default. And if you default, you get a bad credit score and then you're not going to get anything after that.
Right.
And now you're buying your furniture at a store that's selling it for 20 times what it's actually worth.
You're renting your furniture.
You're renting your furniture, right?
Yes, your TV.
And so it creates this cycle that it's almost impossible to get out of. Because if you did even win the lottery, you're going to blow that. Most major lottery winners end up in bankruptcy.
Yeah.
I think it's like 90-something%. It's
Yes,
a stupid number.
It is.
It's like, what? You had $300 million. Like, how did you possibly run out of money?
That's what all me and my friends were talking about this weekend. Was like, if we won the lottery, what would we do? And it was like, that's the ultimate question to ask someone. Cause then like where their heart of hearts is. It's like, okay, are you going to spend it on travel? Are you going to go buy that new Ferrari? Are you going to go do what are you going to do?
I'm going to change my phone number.
I don't even know what I would do. I have no plans.
But yes, play the lottery first, Missy.
Oh, true.
I think it gives you empowerment, financial independence when you understand these basics. You obviously get better financial outcomes. You have less stress, or at least less financial stress. And also you have the ability to lift up your whole family, because it's not that you're giving them handouts, but if you look at the older generation, if they weren't able to provide for themselves, can you provide for them and make them at least comfortable through their lives? And that's the benefit of understanding money and the power of making good financial decisions.
You're modeling that for the next generation.
Correct. So how can you improve your financial literacy? I think the bottom line is, for young people, I think Dave Ramsey does a really good job. I've even thought about maybe we should do our own version. I don't know how you really top his. We can make ours shorter.
Yeah. True.
We could have a 3-hour course instead of a
2-semester course.
Yeah, 2-semester course. But sign up for Dave. He has one at 3 different levels, like really young kids, teenagers, and then college age. Or 3 different patterns. And I think it's $25. It's something super cheap, and you can watch it on your iPad or laptop or whatever. You can subscribe to financial newsletters. You just have to be careful of what you're subscribing to, because typically newsletters have call to actions and they're trying to sell something. So I would just be careful of that. Reading books is important. Random Walk Down Wall Street's one of my favorites for any new hire here, or any intern, I should say, that really understand Wall Street and what actually happens. Rich Dad, Poor Dad, I thought was another book that seemed to really motivate people about how money works. But I'm sure there's lots of other books out there that are just not coming to my mind right this second.
Millionaire Next Door.
That's right. That's a really good one. Yeah, that's a good one. I think we just established that we're not keeping monthly budgets here, but we do subscribe to Pay Yourself First. We know what we have to save for our future. We know what we have to have in reserves, and then anything else is kind of extra at that point. But you need to understand where your money's going. So if you don't know where your money's going, you need to take your credit card statement, your checking account, and then recategorize everything. And there's different apps that can help you do that.
And a lot of banks do that now for you too. And a lot of credit card companies will already go ahead and pre-categorize it, so you're not having to actually go through and do the manual labor. There will be a few that will probably be wrong, but for the most part, they do a great job of fully outlining that.
And honestly, we work with a lot of young people. I had a Georgia Tech guy last night reach out, and we did a little 30-minute session just on the basics of getting started with money. And that's what he was looking for. And, he just booked a 30-minute session with us. So we're always happy to help educate people about things, but we shouldn't be your primary source because typically if you're trying to figure this stuff out, we're probably not managing wealth or developing a financial plan for you yet. It's a little too soon, but there are some great resources out there like the Dave Ramsey program to be able to do that. Anything else you guys want to add?
I would say just don't fall prey to all of the videos that are online or Instagram accounts that are online that are just like preying on the get rich quick method, or, hey, if you invest in these things and subscribe to this newsletter like we're talking about, then we'll give you the best things to invest in and take you through all of this stuff, especially the ones that like go after like a specific demographic. I know that's what their niche is, but like just be careful with those because sometimes they do have great advice, but you just really have to be careful and discern those really well. And I just know there are a few that pop up on my page that I'm like, they're really going after like women investing. And I'm like, you're talking about investing in an individual stock, timing the market of it, and saying that that's how people are going to get rich quick. And it's like, sure, if you pick it at the right time with the right stock and everything, but by the time you're producing this newsletter, it's
old news.
It's
come
old news.
and gone. Yep.
So definitely something to just keep an eye out for. They do have good tidbits. I love Miss Dow Jones on Instagram. She's phenomenal. But little plug.
That's funny. All right. Well, thanks for listening to today's episode. If you're interested in learning more about Wiser Wealth Management or want to schedule a consultation to meet with one of our fiduciary financial advisors, you can do so by going to wiserinvestor.com, or you can click on the link in the episode notes. Don't forget, we have, you can watch all this if you want to see us. You can watch all this on A Wiser Retirement on YouTube, where we also have some other bonus episodes. Episode 124, financial literacy is vital for everyone. And then we have lots of individual videos out there as well. All right. Have a good week, everybody. We'll see you next time.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We'd also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out.
This episode was produced by Edward Resendez.